Hello and welcome to Chapter 5 of our tax book. Now, we're going to talk about a little bit of deductions for and from our adjusted gross income. So, in this chapter, we're going to be learning about this awesome taxes, about how we can deduct certain things. We do want to do that, right? Save a little bit of taxes for everyone. So, we're going to explain how health savings accounts, HSAs, can be used for tax advantage medical care. We're going to describe the self-employment health insurance deduction. We're going to explain the treatment of individual retirement accounts, including our Roth IRAs. Those are fun. We're going to explain the general contribution rules for small business and self-employment retirement plans. We're going to also describe other adjustments for adjusted gross income, or AGI, calculate the itemized deductions for medical expense and for taxes, apply the rules for an individual taxpayer's interest deduction, and determine the charitable contributions deduction, which that one has changed this year. And we're going to describe other itemized deductions. So basically, our Schedule A hits around number 6 anytime we talk about itemized. The rest are kind of above the line, but we're going to basically go through each one. So, starting out first, we're going to hit the health savings accounts. Now, these are actually really cool accounts, I would say, for medical use. So, there is 4 types of tax-favored medical spending plans available for taxpayers. But some are still working, some are not. I already tell you that. First off, we have the Healthcare Flexible Spending Arrangements. These are known as FSAs. And this is where employees set aside money to cover medical expenses. And of course, we're going to go through a little bit of negatives on these. But basically, we're going to do basic info. Number 2, we got health reimbursement arrangements, HRAs. And this is where the employer funds an account that can be used for employees for medical expenses. Then you have what is known as a medical savings account, MSAs. And these are permanent deductions for amounts contribute to an account established for medical expenses. There are for small businesses and self-employed individuals. And this is one of the ones that really you cannot start anymore, as the effective on January 1st of 2008, no new MSA accounts can be established. So that one's dying out. And then last but not least is our good old-fashioned HSAs, our health savings account. And these are a type of savings account established for paying unreimbursed medical expenses by taxpayers who qualify high deductible health insurance. Woo! Yes. These are really good, but why? Why are they good? Well, this is what we like. So, why are they good? Contributions to HSAs are deductions for adjusted gross income, but they are limited to certain dollar amounts depending on age and whether high deductible insurance covers an individual or family. Okay? Earnings and unused contributions accumulate in an HSA are not taxed. However, this is the negative. Distributions to cover medical expenses are not taxed or penalized. But if you receive distributions and they are not for medical expenses, those are taxed. So it has to be for medical. Okay? Cannot take any money out for anything else, or you will be taxed and penalized. Yeah, it's one bad thing about these. So, they're great for medical, but don't take it out for anything else. You're going to find that out a lot with this chapter. They're going to very, very wisely tell you not to take anything out of these accounts unless you do it for specific reasons. So, for 2020, contribution limits for HSA are as follows. Now, for family or self-only, contribution limit was $7,100 and was $3,550 for self. Then we get an additional. Now you're going to see these also happen, which is called an additional catch-up contribution. And basically these are contributions designed to help people that started a little bit later to get to the amount that they should be at. So once you reach 55 or older, you can actually put $1,000 per qualifying spouse for family. Self is just $1,000. But so if both spouses are qualified, that's $2,000 extra. But again, you gotta be over 55 before that actually gets put in. Now, maximum health insurance deductible has to be $2,800 or $1,400. Maximum health insurance out of pocket that you can actually take from these is $13,800 for family and $6,900 for self. Okay. Now, for the contributions, they must be made by April 15th, unless there is some extension that ends up happening that the IRS says, of the year following the year for which the contribution is made. So, yes, since we're, if you're in, let's say, March right now, you still can make contributions to the HSA and be qualified for the 2020 tax return. It's a neat little thing. We'll actually say, same thing will end up happening for, I believe, IRAs as well. But we'll get into that. That's later in the chapter. So, distributions. This is where I was talking about a little bit earlier. Distributions from HSAs are tax-free when used to pay for qualified medical expenses. But distributions not used to pay for those medical expenses are subject to income tax and, look at that whopping penalty, 20% penalty. However, once the taxpayer is 65 years or older, distributions taken for non-medical expenses are subject to income tax, but not the 20%. And distributions from HSAs are reported on Form 1099-SA. So, if you do want to look up more items of HSAs, again, we're just doing an overview because this chapter has a lot of information. Publication 969 is also a good source. You're seeing them not as often, I'll be honest. I haven't seen a lot of people with HSAs, but they do pop up. So it's always good to know what they are and how they work. Okay? So, poll. You know how these polls work. We have Gabrielle is 35 years old and carries self-only coverage in a qualified high-deductible health insurance plan during 2020. Gabrielle may contribute up to $3,550 to his HSA and deduct this amount from AGI. Gabrielle may use some of all the contributions to pay medical expenses he has incurred. However, Gabrielle considers himself pretty healthy and does not engage in any typical high-risk activities. Should Gabrielle contribute to an HSA? Alright. So, again, pause, think about it, what would you think if they should or should not. Alright, so, again, there is no correct answer here. Again, this is basically the opinion of the person. So, if Gabriel needs the money this year to pay non-medical expenses, it would not make sense to contribute to the HSA. Again, because you want to get a penalty if you end up taking any money out. But if he does not need it, he could reduce his AGI and his current year taxes any amount he leaves in the HSA account will accumulate earnings tax-free and carry forward to be available for payment of qualified medical expenses in the future. And after he turns 65, again, he can withdraw it without penalty for other expenses. He just has to pay the tax. So this may be a good vehicle for him to save for the future. Who knows? Again, this is going to be up to their situation. If they're looking at a way to reduce tax, it could be an offer. Alright, we're going to go ahead and combine this one with the next learning objective. Self-employed health insurance deduction. Yes. So, deductible insurance includes the following for self-employed. We get to take medical and dental insurance paid to cover self-employed taxpayer, his or her spouse, and dependents. Medical and dental insurance paid for children under the age of 27 who are not dependents. Medicare premiums. Long-term care insurance paid for taxpayer and his or her family within certain dollar limitations. Again, that varies so much, and the law keeps changing on that. But it is limited. Like every other deduction, it is going to be limited. So, self-employed health insurance, which we would file, can file on Schedule C, or actually on Schedule A, medical expenses. But the deduction is not allowed for any months in which the taxpayer is eligible to participate in an employer-sponsored healthcare plan. So, if somehow they are hired by someone as an employee and that employer sponsors anything, we're not allowed to take it. Again, questions we ask. The deduction cannot exceed the taxpayer's net self-employed earned income. Basically, it just zeroes out the income and that's it. There are individual limitations, again, for long-term care premiums. Now, taxpayers that report income on Schedule C are generally considered self-employed. However, taxpayers with income from certain partnerships, S-corps, LLCs, and farming businesses may also be considered self-employed and eligible for the self-employed health deduction. Nice little thing there too. And then self-employed taxpayers that received advanced premium tax credits under our good old Affordable Care Act, or Obamacare if you want to look at that, may deduct only the portion paid out of pocket, not the portion covered by the premium tax credit. We're actually seeing less and less now the premium tax credit as more people go to private or not buy insurance. Alright, so that completes this part of Chapter 5. Next one is going to be a real doozy because it's going to deal with IRAs. So, I will see you next time for the big, huge portion of Chapter 5.